everyone, this is Abhijit Chatterjee recording our weekly session of Chartsarefun. This is for the week of August 18th, recording this on Sunday, August 24th in the morning around 11 a.m. Last week was a big week for the market on Friday. While the market was kind of trending lower through the week in anticipation of a hawkish speech from Chair Powell at Jackson Hole. This is the annual economic summit that the central bank leaders around the world meet. And turned out Chair Powell completely surprised the market on the positive side. We'll show a little bit about what he said in the statement. He's now leaning towards being flexible about a rate cut. He didn't say when, but he seems to be flexible about that rate cut. Market took it extremely positively. It rallied massively, in particular small caps. So you'll be looking at the small cap Russell 2000 ETF IWM. We will also be looking at the treasuries because those are directly influenced by Chair Powell's rate decisions. So we'll look at from the long term. We'll look at something that we've shared in the past, why Chair Powell seems to be concerned about the indication of unemployment ticking higher. We'll show you a long-term historical chart of what unemployment does when the yield curve uninverts. We are on a current uninversion of the yield curve. It's steepening. So it was negative, the 10-year minus the 2-year, and has gone positive towards the end of last year and has been steepening since then. That typically correlates with rising unemployment. So that's something that Chair Powell's kind of looked back at history and has been raising concerns. So we look at the treasury from the long-term to the short-term treasury yields. The small cap ETF, which is extremely bullish from a longer-term perspective, it has been underperforming the S&P 500 for multi-years, but seems to be reverting and may be about to get on a upward climbing outperformance trend. It's too early to say that, but we'll show you a declining channel and see where the ratio of the IWM to SPY belongs in that declining channel, and if there's a possibility of start trending higher like last we saw in the beginning of this century towards 2002 through 2006 timeframes. We'll see if that's the next trend that the small caps are about to embark on. Then we will take a little bit of a cautious view of the market. We've shared this in the past. We'll look at the VIX chart. We'll look at some patterns on the VIX chart, both short-term and long-term. We'll look at how that correlates to the near-term picture on S&P 500 and the NASDAQ 100 ETF QQQ. We'll look at both of those. Then look at, in particular, some of the high flyers have taken a hit the last couple of weeks. We'll look at Reddit. We'll look at Palantir. We'll look at a big story stock in the AI front and in the news because they will be coming up to the earnings metal on Wednesday. So we'll see in anticipation of the earnings what the charts are telling us on NVDA. And then we often talk about call it a key barometer of speculation in the market. At the same time, it's getting a lot of adoption in the crypto space, Bitcoin. We'll look at the Bitcoin charts and share some thoughts there. So with that, just quickly, our blog site, chartsarefun.substack.com. I appreciate you subscribing to it through email, and we'll get the blogs out to you as soon as they get published in the mornings usually. Our YouTube site is also Chartsarefun. We don't provide investment advice. Our goal is to share interesting, fun patterns on charts and just use these for your own guiding decisions. So that's the disclaimer. We do not provide investment advice. We don't tell you to buy or sell stocks. We are sharing patterns and insights so that it helps you in your trading decisions. So straight into the speech that Chair Powell gave. This is on the Federal Reserve site, and the highlighted in blue is the section that I want to draw your attention, because here he is clearly stating this in that first paragraph towards the last sentence, with the policy in restrictive territory, which he understands that the neutral rate, according to him, is somewhere around the 3 to 3.25. So it's about 100 basis points of restriction that is already around from the neutral rate. he believes that the baseline outlook and the shifting balance of risks. Now, what are the risks? The key risks that the Fed cares about are two mandates. They have a dual mandate. One mandate is about inflation, keeping prices stable. When you have higher prices, higher trends in prices, that's a concern. That's one of the risks that they try to control. The other big risk is full employment. They do not like to see unemployment. They do not like to see job losses. So now they feel, and this is what Chair Powell clearly is indicating, the risk now is shifting from the inflation side into the employment side. And in particular, he has made statements that it's a pretty weak employment environment where unemployment can start going higher, job losses can accrue very quickly, and at this point they just want to be cautious on that. As a result, the key is warrant adjusting our policy stance, is what he said, and that's what the market took as a signal that a rate cut was coming in September. There is the FedWatch tool that people look at that assigns a probability on the rate cuts. That had gone down to 65% of a rate cut in September, the day before on Thursday. And then after his speech on Friday morning, his speech came at 10 a.m., the probability shot up from 65 all the way to the low 90s and kind of settled around the 82, 83% probability of that rate cut. Now, he did say that, just to make it very clear, that this was not a politically motivated statement. They will still be data dependent. So as they said, that the FOMC will make the decision solely on the assessment of the data. And we do know that there is data to be reported for the August unemployment non-farm payroll data coming in the first week of September, usually the first Friday. So we'll get that data coming in, which is September 5th, we'll get the non-farm payroll for August. And also, we have CPI and PPI data coming in for the month of August on September 11th and 12th, or the 10th and 11th, actually. PPI comes in earlier on the 10th, and then the CPI comes the day later on September 11th. And the FOMC comes in and makes the rate decision the week later. So you got CPI on the 11th, and on the 17th of September, on a Wednesday, you'll hear from the FOMC and we'll see what their rate decision is. So that's again, the indication Chair Powell gave that he is concerned about the employment side of the risk. That is taking a precedence over him being flexible about changing his policy stance. And on the inflation side, while he acknowledges that these tariffs can cause inflations, but he felt that those would be like single rises. They would not cause like a long-term rise in inflation. They would cause temporary rises and then settle off, is his main thinking. And also he did say that the PCE, which they fall as their inflation gauge, will settle around 2.9 is his prediction for the month of August PCE, which we know will come out end of the upcoming week. And from his perspective, he's raised that target of inflation, which used to be 2%, which is what the Fed was maniacally watching, to 3% now. They feel that the current economic conditions kind of warrants a 3% kind of a level to watch, as long as it doesn't run off. PCE doesn't run off too far from 3%. They'll be comfortable considering that the risks on the inflation, as long as it stays 3 and below, is well contained. And now I'm focusing more on the employment side, and that has crept up to 4.3, and if it crosses 4.5, that's a very big red signal. So now let's look at a historical chart of what unemployment does when yield curves steepen. So here we can see a chart going back to 1976 on S&P 500 right here. We see unemployment rate on the topmost panel. We see the yield curve, which is the 10-year yield subtracting the 2-year yield from it. So 10-year yield minus 2-year yield. And then we show the 2-year yield and the 10-year yield right below it. What do we see? With these purple vertical lines, we are showing periods when the yield curve, in this case the 10-year minus the 2-year, starts steepening, as in you have from 0 level going up to level towards 2.5, towards the 3%. So that steepening came in the 1990s. Guess what happened to unemployment? Unemployment ticked higher. The next steepening happened in the 2000 after the dot-com collapse, from 2001 onwards. That steepening happened. Yield curve from 0 went up towards the 2 to 2.5 level. What happened to unemployment? It crept higher. The next thing happened during the financial crisis that collapsed on the 2007-2008 timeframe. Yield curve steepened, unemployment crept higher. This next one is COVID, which is kind of a misnomer. It was a one-time, unfortunate event. But when that happened, that was a pandemic kind of a strike. Unemployment, of course, shot up huge, but that very quickly came back because people were sitting at home pretty much, quarantine and not being able to go out to work. But that quickly, when the vaccines, the amazing discovery of the vaccines came up and COVID recovery came through smoothly, unemployment quickly came back down. But during that period as well, we see that the yield curve did steepen for a few months. What is happening now? Since the late 2024, the yield curve has begun to steepen. We have not gotten to the 2 or level higher. We're right now at 0.56, as in the 10-year is 0.56 or 56 basis points higher than the 2-year. But the key thing here is if this steepens, we have seen unemployment fairly flat. We can see it hovering around that 4.2 level. What could that do? That could start steepening. We've seen those every incidence in these vertical purple bars that when the yield curve steepen, unemployment. So that's the thing. That's what Chair Powell is taking this history lesson, looking very carefully at the labor situation right now. And if it turns out that with the concerns of the weakening consumers, with overall, tariff-related cost pressures in the companies start letting people go, that could effectively cause the unemployment to tick higher. And it could, in some ways, cause some form of a GDP going down lower as well. And he did say that GDP was near the 2.6, has come down to half to 1.3 this year so far. That's also a concern. So if the economic growth is coming down, tariff-related cost pressures cause companies to start letting people go, you could quickly see this unemployment tick higher. And that's why Chair Powell started acting. Now, what are the treasury curves, the yield curves telling us? Let's start with the 2-year. 2-year took the biggest fall, 8 basis points. It fell from 3.78 to actually 3.79 to 3.71. That's where it closed. The 10-year also fell about the similar, 7 basis points. So at the end, the yield curve steepening wise didn't have much of an effect. It only steepened by just 1 basis point because the 2-year fell by 8 and the 10-year fell by 7. But if you look at shorter term, look at the 1 month. 1 month actually went higher. That's, I find, shocking. The market is so convinced that Chair Powell will cut rate in September. Why would the 1 month yield go up to 4.35? Well, what is the 4.35? That's our current Fed funds rate, between 4.25 to 4.5. Take the midpoint of that, around the 4.37. Well, 1 month yield curve is showing us 4.35%. That means 1 month from now, which is we are around 22nd of August. 1 month from now is September 22nd. When does the FOMC decision come? FOMC decision comes on September 17th, which is less than a month. Why is the 1-year yield not already reflecting that? It should have been down by 20 to 25 basis points, reflecting that 4.4 to 4.25, somewhere around 4.12. So it should have had an immediate drop. But very interesting wise, true smart money is not 100% sure about that rate cut in September. Market realized that the PPI had been higher. PPI had been hot. When PPI came out recently, PPI was significantly higher from the previous month. PPI in August came in on the core PPI at 3.7%. The core PPI the previous month in July was 2.6%. So producer prices, which is where the impact of tariffs come in, because where are the producer prices? Those are the importers who are importing the goods and then passing it out to the consumer through the retailers. They get impacted first, and the producer prices shot up 110 basis points. And from 2.6, it went up to 3.7. This is year over year. And from a month over month, it was 0.9. That was a hot PPI. CPI has not yet heated up as much. CPI went up to 3.1, the core CPI. But if you heard Walmart CEO, their earnings, they missed an EPS in a long time. They have clearly raised concerns, the CEO of Walmart, that he sees cost pressures causing them to raise prices. Walmart is supposed to be the place that you price at the best, lowest price. That's what they're known for. They have the best pricing for any retail, grocery, any items that they sell. They have the best, they're the king of pricing. Yet when Walmart gives you an indication, their CEO, that in the next couple of quarters, we might be forced to raise prices, that will directly show up in CPI. So be careful. This is potentially what the market is concerned about, that maybe when we do get the August CPI and PPI reported in September 10th and 11th, got to watch, and maybe that data may be hot and the hotness continues. Fed may not do that rate cut decision right away in September, or even if they do, they may do a hawkish rate cut, as in say one cut and we are done. At this point, the fact that the 1-month treasury yield has not even fallen, just went up slightly by 1 basis point from 4.34 to 4.35, the market thinks possibly, yes, there's a rate cut, but not maybe into September, maybe into the October FOMC meeting. So then look at the 3-month treasury yield, and there you can see the 4.19 yield. So there you can see 4 basis point yield drop. That seems to be where the market thinks that there is 3 months ahead from August 22nd. You're talking about the November 22nd. In the 3 months, you got 2 FOMC meetings, one in September, one in October. So the market thinks there's only going to be one rate cut in these 3-month duration. As a result, they're pricing that 3-month treasury yield at 4.19. So that's telling you what the smart money is thinking. As much as the market's excited that we are off to a massive rate cuts coming. Now the key is longer term, though. The 2-year you can see is at 3.7. So the market does expect not one cut but multiple cuts. That means in the 2-year, market expects from like 4.25 to 4.5 is where the current Fed rate funds rate are. Market expects it will go towards the 3.5 to the 3.75. So a 3.5 that's more like a 75 basis point cut, as in 3 cuts is what the market expects in the next 2-year durations, while the 2-year yield is in the 3.7 region. So we'll see what it does, but extremely interest rate sensitive area of the market called the small caps Russell 2000 ETF IWM broke out, and we see this breakout happened earlier in the year from the June timeframe. An inverse head and shoulder, beautiful inverse head and shoulder with the neckline at 209, the head at 171. That measures close to almost $38 at 38 to 209, 247.84, round it up to 248. That's where that inverse head and shoulder on IWM is. But guess what the rally was? 4% rally in small caps happened on Friday on that bone that Chair Powell threw in, saying that we are looking towards warranting our adjusting our policy stance, which means the market celebrating, thinking this is rate cuts are coming. Now, if you look at another view, which is a more bullish view, is you can draw the neckline higher from, instead of using the 209 as the neckline, move it up to a neckline near 226, 227. Look at the left shoulder, 212.9. Look at the right shoulder, 212.34. So the 212 is the left and the right shoulder. The head remains at 171. 171 to 226. That's roughly 55 points. Add that to 226.7, almost 227. That gets us to 282. So even a higher target, the bulls would be painting on the IWM. Now, what is the long-term trend of the IWM to the SPY? This is a quarterly chart. Every candle is a quarter of the ratio. Look at this declining channel. It has been steadily coming down since the COVID period from 2020, and it briefly crossed it during the 2022 bear market pullback, because usually what happens is when the bear market periods come in, usually what ends up happening is small caps outperform, as in they both come down, but the S&P 500, because the mega tech stocks Those are a bigger part of the S&P 500 weight. The tech stocks in particular are almost 34% of S&P 500's weight. They pull the S&P sharper down than the small caps as much. So that was when briefly it crossed above that declining channel top trend line, pull back, declining since then. Now look at this candle. This is a quarterly candle. As of this quarter, which will end September 30th, we are higher than the previous quarter's candle. So, and then we had briefly touched a 0.277 near 0.364. If we are able to break out of this declining, this is a longer term trend. We can see back in the early 2001 to 2006, that is when that ratio climbed. Since then, stayed flat for a duration of 2007 through almost 2017, up and down in a flat horizontal region. And then the steady decline happened in the last 5 years, 2020 to 2025. Are we about to see a climb? That's what the bulls on the small caps will be looking at. By the way, the ratio climbing does not mean that IWM has to go up. It means that if they both fall, it'll outperform, it'll fall less than the S&P 500. If they both go up, IWM will go higher than the S&P 500. But potentially, if rates are going to be coming lower, if the yield curve steepens. Another key point, I do want to look at the historical chart and say, when steepening happens, look at all these steepening events, the yields come down. Yields on the 2-year comes down more than the 10-year, but they do come down. You see the 2-year and the 10-year came down, 2-year and the 10-year came down, 2-year and the 10-year came down. Same here in 2020. We are now kind of coming down, but not as sharply as we have in the past. And 10-year is not even coming down. It's staying flat in that 4.2 to 4.5 level. So that's what we got to watch. Will yields start coming down? And that will be incredibly, incredibly beneficial. For small caps, it'll be incredibly beneficial for home builders. That's why home builders rallied over 5%. XHB rallied over 5% on the news. Now, I'm going to shift to volatility to see what is VIX telling us about potentially, are we about to repeat what happened in 2022? Well, look at VIX in the 2022 timeframe. Look at how it traded in an upper band from 18 on the low to 38 on the high in the entire year of 2022 to early 2023. Then it pulled to the lower band, trading between 11 to 23 for entire 23 and 24. That's when we were recovering out of the cyclical bear market and climbing higher till all of 2024, and then came 2025 with the tariff war, with President Trump's raising concerns on prices shifting higher and so on. The trade war related to tariffs caused a massive spike of VIX to 60. But look at the long-term moving average on the weekly. The 50 is in blue, the 200 is in red. What are we seeing? We're about to see a golden cross like we saw in the early 2022. That golden cross indicates that VIX will now start trending higher, and maybe we will be reaching that same kind of upper bound on 16 to 17 on the low to 38 on the high. Also look at the MACD histogram. That's raising higher lows. That MACD histogram indicates that we have pulled back enough on the MACD signal line for it to start climbing like we saw in 2022. We saw the duration of MACD was climbing. Maybe be about to climb on a higher VIX trending, and that could mean VIX higher usually indicates market pullback. So this indication that potentially a golden cross on the VIX, the MACD slanting higher on the histogram indicating a higher VIX, potentially means that we could be seeing a market sell-off. Now look at something more interesting on the periodicity of when the VIX spikes come. This is looking at a weekly chart, but let's look at the spikes in 2024. We got 3 such spikes, one in April, one in August, one in December. What is the gap between them? 4 to 5 months. The number of candles, these are weekly candles, either 15 to 19. So we got from April to August, we saw a spike. Then we saw from August back, this is the August spike up to 65 that we saw from the Japan carry trade stock market crash. Then we got that in December when, Trump, after Trump got elected, but then the rate cut fears came because Fed said that they had going to be pausing for the rate cuts. VIX shot up there to 28. Then we came into the April, seventh low of the market when the trade war hit its crescendo on that April 7th low. VIX hit 60. Look at the duration. We've drawn a vertical line. We've not yet seen the VIX spike. VIX, if any, has trended lower from 60 to lower lows at 14.22. But the MACD is indicating an upper range on VIX, an upper breakout on VIX. And it's not just slowly trending higher. We've seen these spikes come in VIX every 4 to 5 months. We are overdue for it. From the April to the 4-month, it was early August. We're almost past August. So coming into September, we are predicting there is going to be a reasonable chance of a VIX spike coming. And why is that correlated to the market? Well, look at what the S&P daily chart is telling us, S&P 500. Massive climb from 48.35 to 64.81. But as we have climbed higher highs in the last few days in August, RSI is printing a lower high. That's a negative divergence. MACD's been printing lower highs ever since the May climb. We can see it flattening to negatively sloped MACD all across since the May timeframe. This is an indication, and these are using Fibonacci moving averages 8 and 21. We had almost, like the last time we saw that bearish cross of the 8 going below the 21 was in February, and then we saw how it came lower. We almost came close to doing that in mid-August, massively recovered, luckily recovered from it. And now we had 1.5% on the S&P 500 because of this is a daily chart because of dovish Chair Powell. But that's the key to be seen. Are we going to be able to take out 64.81 and print a slightly higher high? But what happens to RSI? Maybe RSI prints a lower high. What happens to MACD? MACD continues to print a lower high, and then we break down. So now, if I look at the 5,700 we have shown in the past, from 48.35 to 5,700, that's an ascending triangle. And 48.35 to 5,700 measures to close to say 865 points. Add 865 to 5,700, that's 6565. So we are at 6466. We had touched a high of 6479, 64 within 2 points of the previous high at 6481. That's not a lot. 64, 66 to about 100 points of S&P potentially. If the momentum is there for this week, we could get there. But from there, we are looking for an S&P to pull back. And that's what we need to be cautious about. Look at the NASDAQ 100 ETF QQQ. On its daily chart, same Fibonacci moving averages 8 and 21. Short-term 8, that's what it climbs, hugging the 8 in blue. It keeps climbing, hugging that. Every once in a while, it breaks below it, comes closer towards the 21, then recovers. Did that in the June timeframe, tested it, recovered, then started climbing, hugging the 8, pulled back towards early August. Now, look at the recovery on the QQQ on Friday. It was not as strong in terms of going back towards its high, still quite far away from the high. S&P came within 2 points, but what about the NASDAQ 100? It came to 573.99 or 574 to 583.32. So that's almost $9 higher away from the peak. And look at 574 here. This could turn out to be like a head and shoulder top. A left shoulder to 574, a neckline around 550, on 552, head at 583, came to 588, slight 558, slightly higher low. But then if this fails at 574, this moving average, the shorter term 8 goes below the longer term, in this case, the 21. That means we are setting up for what we saw in February. So that's what we are watching. This came close, but it did not dip below, the blue did not dip below the red, and it recovered. But now maybe it breaks lower. What are some early indicators? Look at the massive movements of stocks like Reddit. What did Reddit do? Reddit topped out a week before, and you can see from there, it topped out, it came back and closer towards, see how far the 8 had deviated from the 21 in the February time frame. And then from there, it started waterfall decline. Are we getting for the waterfall decline? Look at MACD. MACD is had a bearish break, and then from there steady decline for a couple of months. Well, MACD's also had the bearish break. We had direct drop, sharp drop in a vertical fashion from 253 to 205. So that's almost close to almost 48 points, almost 20%, almost 18% drop in the Reddit stock, which we know is an AI stock. They are huge. Their content is monetized by OpenAI and others for their, for training the models. So Reddit, we can see, is printing a bearish candle on the Chair Powell's news. It ended up negative. And look at the 10-minute chart. It shot up. You can see the vertical climb, and then all of those gains within the hour. Chair Powell's news came at 10. From 10 to 11 for an hour, it climbed. But guess what was smart money doing? Smart money was selling all along and broke it down towards the lows of the day. So that, to us, indicates the risks are higher for growth stocks to pull back. Look at the other mega growth cap stock that has shot up. 4 billion in revenue, 400 billion in market cap. 100 times sales is what Palantir sells at, an AI darling software stock. What has it been doing? Well, it is almost very close for a bearish cross of the 8-day moving average going below the 21-day moving average. We can see the blues about to dip below the red, exactly like what we saw in February. Look at MACD. MACD has gone bearish and kept falling. MACD has gone bearish and is falling for several more days of it to fall. So we could expect Palantir from 142 to 190, talking about a $48. 48 subtracted from 42 takes it towards $94. And that's potentially where we think Palantir could fall if it breaks below 142. That's something we got to watch. And same thing, the candle was not strong enough. It was up to $2.50 or 56 cents on Friday, but left a tail on the top. The bearish cross here, the bearish cross of MACD, indicates that Palantir will have weakness moving forward. And then the AI darling stock, NVDA, look at its 8 and 21 moving averages, about to dip and have a negative cross. Guess where the negative divergence on the RSI showing weakening as it's climbing higher highs in price, lower highs in RSI. That's a weakening pattern. Why are we talking about NVIDIA? Their earnings is on Wednesday. So these are the two possible things we see NVIDIA could do. One is if you look at this cup and handle from 143, which was its February peak, came down to 86, sharp drop, came back to 143, formed a nice handle. That cup and handle from 86 to 43, that's $57. At 57 to 143 is 200. So this cup and handle measures to 200, and we didn't quite meet the 200. We met 184 and pulled back. If NVIDIA announces a bullish next quarter projection, and we know that CapEx spending has been incredibly high on GPUs by all the hyperscalers, whether it's Google, whether it's Meta, whether it is Amazon, or Tesla for that matter, incredibly spending, voraciously buying GPUs. So if their projections, and then they're trying to recover on the China side, they've now got some of the export controls, made a deal with the government that they'll share some of the revenue from China with the government. And that's helping maybe bring in a good forecast for the next quarter. If they are surprising the market on the upside, expectations are very high. If they do, then potentially think about this 184 to 168 back to 184, forming a slight handle and a breakout. So 168 to 184 is $16. Add 16 to 184, that's 200. So potentially, if it is very bullish, we could see 168 to 184 and a break higher to the 200 is what this could do. But if it is a bearish breakdown, looking at that negative divergence on RSI, looking at the breakdown in the MACD with a negative divergence as well, that measured target from 168 to 184, $16 subtract from 168, 152. And we can see that 152, 153 was previous resistance that now becomes support. So here's a possibility. I think we are eventually going to 200 on NVIDIA, but we may not go there in one shot. We may have the classic September pullback come towards that 152 level. That would be a buying opportunity depending on how volume patterns shows up. And then from there, it came to its level of the 200. So if it does break down to below 168 towards the 152 and holds that support, that would be a buying opportunity for us to take that move from 152 to 200. The only caveat on this cup and handle is that there was no volume Typically, when you have a true cup and handle at that breakout above that neckline, above that brim of the cup at 143, you should have seen very strong volumes like you see. If any, volumes are on the red when it drops. You see dollar distribution volume. When it breaks higher, there isn't very strong volume. So that says that a lot of new money is not pumped in on that breakout. So this could be a failed pattern. It may not be a cup and handle after all. It could be a failed pattern. And we never get to see the 200. If any, this was a double top at 183, 184, and the breakdown takes us to 152. So that's the prediction on NVIDIA this Wednesday. On the bullish front, if it can break 184, $16 from 168 to 184, add 16 to 184, gets us to 200. Why is 200 a target? Based on this cup handle from 143 to 86. 86 to 143 is 57. Add 57 to the top of the cup at 143, that's 200. So that's the upside. The downside is kind of a breakdown from 168 to 184. $16 from 168 is the 152, which is where we see the strong support because of the past resistance. That's NVIDIA. You're going to end with Bitcoin, as I said. Bitcoin daily chart is indicating a double top. At the same time, that's for the bears, and for the bulls, a potential double bottom. The double top is at the 123 to 124. Negative divergence confirms a double top, lower high in RSI when the higher high in 124.5 was tested. The positive divergence in the MACD histogram confirms a double bottom, 111.9 in early August. On Friday, before Chair Powell's speech, it hit 111.7 briefly and rallied higher. The last couple of days, we know Bitcoin trades 24/7. So Saturday and Sunday, it is pulling back, but it's a shallow pullback so far. This could be a handle and then a climb higher. What is the climb higher measure to? From 111.7 to 117.4 or something is what I think it has climbed to, and from there pullback. So that's $6,000. Add 6,000 to 117, 123. So this could, if any, be a neckline of a head and shoulder around 111.7, 111.8. That's the left shoulder, that's the head. A right shoulder pull back to 120, reversal to 123, and then the break. If that breaks down, 111 to 124, you're talking about close to almost 13,000, 12,800. 12,800 from 111.7 takes us towards 99,000. So that's what we got to look at, and we got to see if that's where 98,900 is where we think this could come down to. We got to watch that carefully, and that's where this double bottom breakdown measures. We know that so far it's at the lows of the day, 114,340, 114,482 is where it is currently, and that's what we got to watch and see if can it pull up from here and then go towards the 123 and break down. Now, if you look at Bitcoin's weekly chart, this is a bearish looking wedge. Look at the highs and look at the lows. That looks as a bearish wedge. Look at that negative divergence. And also the declining volume, which is what bearish wedges typically highlight. As the wedge forms, volume declines. And look at MACD, negative divergence. Lower high on MACD, lower high on RSI. And we already broke below that lower trend line of the wedge on Friday to then recover some and close right at that lower trend line. So we got to watch. The week ends this evening at 8 p.m. That's when the Sunday starts and the next weekly candle will print. Let's see if it manages. It's right now hugging right that lower end of the trend line. If it manages to just, escape breaking down and maybe make that slight reversal towards the 123, as I was saying here, right? If that is a small kind of a V-shaped cup with a handle and then the break higher of a 117 towards that 123 test again, then in that weekly, the next candle we print could come towards the 123. But this will perhaps not able to exceed this. And if you look at a longer term monthly chart of Bitcoin, you can see the two previous peaks. After post halving, a year later, we get a peak. 2017 was the previous peak. Then we got the peak into 2021. And then joining this peak that we recently got at 124,000. Look at RSIs, much stronger in the 2017 peak, not as strong in the 2021 peak, a lot weaker in the current peak. Negative divergence, tested that trend line, joining the highs of the previous peaks. And this bearish wedge. This is a bearish looking chart from the longer term perspective. As much as Michael Saylor and others are all talking about million to 24 million targets over the next 20 to 30 years, near term, at least in the next few months, if we are able to break higher, the weekly chart does have a pattern from 69 to 15.5 to 73,800 that handle pullback and the breakout. So 15.5 to 73.8 is 58,300. 58,300 to 73,800 is 132,100. So that's a possibility. We might be able to recover, slightly break above this bearish rising wedge and maybe hit the 132 and then break lower. That's a possibility in the bullish side. But if you see the long-term chart, we've tested that rising trend line of joining the peaks, pull back from it. The candle looks bearish. We can see a long wick on the top and then closing below that top of that month. This current month has also got a bearish looking candle printing. You can see a long wick on the top and a short wick on the bottom with a very short body. So that's also kind of a reversal doji right there, and also a shooting star in many ways, a shooting star kind of a candle. The month so far does not look bullish on Bitcoin's candle. This is the month of August, and if that confirms it, the bearish wedge breaks, we could be seeing a level test towards that 100K, 99K is where we think Bitcoin could come. So in summary, Fed chief did give like a dovish kind of statement to the market saying balance of risk warrants adjusting our policy stance. That said, he's looking at the unemployment creeping higher, as we've seen in the previous steepening of yield curves. We are at the very early stages of steepening of yield curve. We are only 0.56. In the past, the yield curve steepened to 200 basis points or higher. So we have still got another 150 basis points of steepening to come. And in each and every one of those instances, unemployment has ticked higher, which is what he's watching. He as in Chair Powell. Of that unemployment ticking higher concern is why he's beginning to start cutting rates. But that said, the 2-year yield took a drop, 8 basis points. 10-year also took a drop of 7 basis points. And if any, the market expects rate cuts to come, but not. And if you look at from a 2-year yield at 3.7 and the current Fed funds rate between 4.25 to 4.5, which is about the midpoint, say around 4.37, you're talking about 3 rate cuts, 75 basis points or so is what the market pricing for the next 2 years. But short term, if you look at the 1-month treasury, it went higher. So that means 1 month is 1 month from August 22nd, which is September 22nd. And you got a FOMC rate decision on September 17th. If the market was so confident that the rate cut would have come on September 17th, this would have already priced that in. And 4.35 should have been towards the below 4.2. That did not happen. The 1-month yield actually went up 1 basis point and closed near that 4.35, which is kind of very close to what that Fed funds rate is now. So market doesn't expect a cut there. And into 3 months, market expects only 1 rate cut. Why? Because you can see that it's pricing at 4.19, which is 25 basis points from the 4.37 is what market is thinking in the 3 months out from now. So August 22nd, 3 months out, we're talking about November 22nd. In between that 3 months, we got 2 FOMC decisions, one in September 17, one in October, about the 23rd or so. So 2 FOMC decisions, and the market expects only 1 rate cut. So with that, the small caps are acting bullish, whether you paint an inverse head and shoulder with the 209 neckline that measures to 248, had a very solid breakout on Friday to higher highs. Now it's going to go try to retest that November high at 243. Good momentum, good volume on the breakout. So small caps are acting bullish. If you use inverse head and shoulder with a neckline at 226 or 227, that measures even higher to 282, something for the bulls to rejoice. And more key is for longer term trend on positioning into small caps for the next several years, because when that trend starts going higher, it goes on for a few years, like you saw in the early 2001 to 2006, it started climbing, then flat, then it has been declining since 2005. We're going to watch this declining channel and see if it can break higher. This is the ratio of IWM to SPY. If this can break higher, it might be a smart bet to start positioning your allocation more into small caps. And that could potentially mean, as we've said, from historical chart of S&P, when yield curves steepen, rates fall. Yield curves steepen, rates fall. So 2-year rates falling, very bullish. 10-year falling, 10-year falling, very bullish. That is aligning with ratio chart saying be prepared to allocate. You get to small caps on any pullback, and nothing chase it right now. Get a pullback, and on pullback, start allocating into small caps. They may be coming into a period of the next few years, outperforming S&P 500. VIX is telling us that there is potentially off the golden cross indicating VIX upper trending coming into 2026. So we may have a repeat of 2022, which was a bearish year for the market. Another bearish year may be shaping up in 2026, looking at that golden cross of the VIX weekly chart. MACD histogram is showing potentially that break over higher. And that, what does it mean? It means that VIX will stay elevated at the lowest on 16 and the upper on 38 for an entire year. And that higher elevated VIX could mean more, options premium for the markets. Option players will have a great time in the markets, but at the same time, a rockier market. And in particular, every 4 to 5 months, we see VIX spikes. So going back from April of 24 into August, into December, into April, August has come and almost gone. We might be seeing that VIX spike coming, if not by next week, which is the end of August, into early September, we see this. It's long, in the tooth. The duration has come to 4 to 5 months here. MACD is indicating that higher low on the histogram, indicating potential turn higher on the VIX. So looking for a VIX spike in the next few weeks in the month of September for very likely. S&P is indicating it's kind of getting tired. In the recent higher high, RSI did not follow with the higher high. RSI shows negative divergence. We're looking for the 8-period moving average going below the 21. It came close, but it did not, and snapped back higher. But like we saw in February, we're expecting that into September, the 8 going below the 21. How low we think it can pull back? If you do 6,212 to 6481, that itself measures close to 200 and 70 points or so. So 270 subtracted from 6212, you're talking about 49, 59, about 59.40 or so. That's where we think this could come down to. That's kind of where the previous resistance in 59.60, 59.70. We see another support here is where we think between 5,900 and 6,000 is where we think this breakdown could measure to once it breaks. So we see that 6212 twice, 6200. That's the key support. That's what we're looking. This is in many ways a broadening top. Base at 62. Higher tops, that breakdown. So below 62, we expect a break below 6,000 towards the 59 or so, and then maybe another rally towards the end of the year. Classic seasonal uplift in the market into October, November as the rate cuts come into play. So at least in the next 2 to 3 weeks, Fed's decision does not happen till September 17th. Maybe market gets nervous. The celebration was temporary. Hot data on the employment, if any, comes out, not as fearful as the Fed turns out to be. Maybe the employment data gets revised. It's been very unpredictable with the non-farm payroll. If it gets revised, if unemployment stays at steady level, not going much higher, we might see, and then if CPI, PPI come even hotter than what we saw this month, that could cause the market to get nervous about giving up on the rate cut, and that could cause that sell-off in the early part of September. QQQ, we know, is also getting ready for a bearish cross of the 8. Was already turned lower below the 21. It was weaker. It does not come anywhere close to its high like the S&P did. S&P has come almost within 2 points of its high. QQQ is still from 474 to 574 to 583, 9 points away from its top. If that fails at that 574, kind of left shoulder and the right shoulder and breaks lower, we can expect this to go towards 530s, and 530s is where we see there is potentially actually this is the daily chart here, right there. 530s is where we see there's a gap. This gap at 490s is unlikely to be filled right now, but at least in the next 2 to 3 weeks by September 17th FOMC decision, this gap near 530 could get closed out if we break below that 551. That's just like when S&P, a key level we're watching is the 6200. In the NASDAQ QQQ, a key level we're watching is 551. That break, 551 to 583, they're talking about 32 points. 32 from 551 measures us toward the 529. So that's where this gap can close out. 530 to 529 is where we think we potentially could get QQQ. Reddit, hot AI stock, gave up all its gains in the first hour of trading after Powell, indicating smart money is getting out of the stock. We can see that in its sharp drop from 253, almost a 25, almost a bear market kind of drop already in Reddit in 3 trading days. That's what happens when things go vertical, they come down just as fast. So we can expect Reddit already failed. A bearish looking shooting star candle on Friday failed at its rising 8 period moving average, which is now declining, started to come lower. We expect this to now come lower sharply. And as Reddit has its waterfall decline, this will have a bearish cross and start both declining, both the 8 and the 21 period will start coming down. That's what we expect. So expect very bearish move in Reddit. Same thing with Palantir, poised for a breakdown. It's almost the 8 is about to dip below the 21. Palantir is repeating what it did in February into March. That repeat means it breaks below 142 and likely even tests 100 or lower is what we think on Palantir. NVDA, earnings is on Wednesday. We think if the bullish, very, very bullish move happens, then there is a cup and handle from 143 to 86, measures to 200 because the depth of the cup at $57, at 57 to 143 to 200. So that's where NVIDIA could go. But could it go there right after earnings, or could it first pull back? Because we do see negative divergence, lower highs in RSI, lower highs in MACD as it has climbed higher highs. So if there's a bigger chance of it falling because expectations are very high. We can see that the 8 is about to bearish cross below the 21. And how low can it fall? 168 to 184, $16. Subtracted from 168, 152 to 153. That's where we see previous resistance, which we believe will be strong support. So if you do get that dip to 153, it would be a good buying opportunity because this cup and handle measures to 200, where we think nice round number, NVIDIA could eventually climb by the end of the year. So a buying opportunity at 152 would be a great chance to buy NVIDIA. Bitcoin from a daily chart has a double top as well as a double bottom. We are yet to see which one will end up resolving. The double top measures from 124 to 111. So that's closer towards 124,500 to 111,700. That measures closer towards 13,000, 12,800. 12,800 from 111,700 measures exactly to 98,900. Below the 200-day moving average at about 100,800, go below it and test that, level at that 98,300 that we got in the June timeframe. That's a potential possibility. This double top, if the double bottom pans out though, you would expect a breakout above 124 and climb towards that weekly chart target towards 132. That cup and handle on 69 to 15.5 to 73,800 measures to 132. Longer term chart, however, is very bearish. On the monthly, we can see it has tested its rising trend line, joining the previous peaks in 2017, 2021, and the most recent peak. It has joined and reversed. Monthly bearish candle here, leaving a long wick, another monthly bearish candle of a shooting star, and breaking below that rising wedge. And that could mean that pullback towards the 90,000. MACD here also you can see is at lower highs on the histogram. Like as the RSI is showing negative divergence, we can see negative divergence on the MACD histogram. So be careful about Bitcoin. I would not get carried on and just keep buying Bitcoin like no tomorrow, as Michael Saylor, Tom Lee, and others are recommending. I would be very cautious for this double top breakdown in Bitcoin and head down towards potentially a dip below 100,000 towards 98,900. Good luck investing. We'll have another volatile and an interesting week next week for sure. Thank you.